Hey everyone, welcome to this week's episode of FAQ Friday. Today's question comes from Angela, and she wants to know what I recommend when it comes to taking out a mortgage. Now, there are a few things that I always consider when it comes to doing your home loan. The first thing you want to do is pay a 20% down payment. The reason I recommend this is not only are you going to get a head start on your mortgage, you're going to avoid paying PMI. PMI stands for Private Mortgage Insurance. It's basically an insurance plan that you have to pay to protect the lender in case you default on the loan. Now, years ago when we got our home loan, unfortunately, we didn't put down 20%, so we got stuck paying PMI. Our PMI bill was $139 a month. We got stuck paying that for 5 years, and it totaled up to $8,340. That's money out the window. Another thing I always recommend is that you take a shorter term than the standard 30-year mortgage term. If you can walk away with a 20-year or a 15-year fixed rate mortgage, you're going to end up saving hundreds of thousands of dollars. Take a look at this graphic that shows a 15-year mortgage versus a 30-year mortgage. If each person took out the same loan amount of $222,000, a 15-year mortgage is going to give you a slightly lower interest rate than a 30-year might give you. Now, if you look at the monthly payments, yes, your monthly payment with a 15-year mortgage is going to be higher, and in this case, it'll be about $400 higher. However, take a look at how much you're going to save. For the 15-year mortgage, you're going to pay $61,318 in interest over the life of the loan. Whereas with a 30-year mortgage, you're going to end up paying $177,265 in the life of the loan. That is a difference of $115,946. I don't know about you, but that's a lot of money that I would like to keep for myself. If you're already in a 30-year mortgage, one thing you could do is look into refinancing for a 15-year mortgage. If the cost makes sense, go ahead and do it. Another alternative is to pay your 30-year mortgage as if it were a 15-year mortgage. You can add extra payments onto your principal every month and end up paying it off sooner. Now, on that note, a common question that I get is, should I refinance? And the answer is different for everyone. It all depends on what your current interest rate is and how low of an interest rate you could end up getting. You have to look at how long is it going to take you to recoup the money you're putting in at closing. For example, let's say you save $1,000 a year on interest payments, but you paid $4,000 at closing to do the refinance. That means it's going to take 4 years in order for you to recoup that money you spent at closing and to start saving money. So if you're planning on moving in less than 4 years, that option doesn't really make sense. Alright guys, that's it for this week's episode of FAQ Friday. Do you have a question that you'd like me to answer on my video series? Send it to info@craigdacey.com or leave it in the comments box below. If you'd like a copy of that 15-year versus 30-year mortgage PDF, click on the link in the show notes and I'd be happy to send it to you. And as always, if you enjoyed today's video, hit that share button for me and share it with all your friends. Have a great week and happy budgeting.